Hello, and welcome to a simple guide to the U.S. tax system for beginners. If the word taxes makes you feel a little overwhelmed, you're in the right place. Over the course of this series, our goal is to break down the essential concepts of the United States tax system into simple, easy-to-understand chapters. We'll demystify the jargon and give you a solid foundation of knowledge, one step at a time. Before we dive in, it is incredibly important to state that this guide is for informational and educational purposes only. I am not a financial advisor, tax professional, or attorney. The U.S. tax code is complex and changes regularly. You should always consult with a qualified professional, like a certified public accountant or a tax lawyer, for advice tailored to your specific financial situation. This series is designed to give you a foundational understanding, not to provide specific financial, legal, or tax advice. With that said, let's begin with Chapter 1. Why we pay taxes and who has to. So, what are taxes really? At its most basic level, a tax is a mandatory financial charge imposed by a government on an individual or a company. This money is then used to fund various public expenditures. Think of it as our collective contribution to the society we live in. It's the membership fee for a functioning country. But where does all that money actually go? This is one of the most common questions people have. The taxes you pay are pooled together by federal, state, and sometimes local governments to pay for a vast array of public services that we often take for granted. At the federal level, your tax dollars fund huge national programs. A significant portion goes to Social Security, which provides financial support to retirees, people with disabilities, and surviving family members. Another large chunk funds Medicare and Medicaid, which provide health care for seniors and low-income individuals. National defense and security, including the military, are also paid for by federal taxes. Other federal expenses include building and maintaining interstate highways, funding scientific and medical research, operating national parks, and paying interest on the national debt. At the state and local levels, tax revenue pays for things that are even closer to our daily lives. This includes funding for public schools and universities, paying the salaries of teachers, police officers and firefighters, maintaining local roads and bridges, and operating public libraries and parks. Essentially, from the streetlights on your block to the public schools your children might attend, tax dollars are at work all around you. Without this system of collection and spending, these essential services would not be possible. Now, who is in charge of collecting all this money at the federal level? That would be the Internal Revenue Service, or the IRS. You've probably heard of them. The IRS is the nation's tax collection agency, and is a bureau of the Department of the Treasury. Their job is to administer and enforce the tax laws passed by Congress. While the IRS can seem intimidating, it's helpful to think of them simply as the government's accounting department. They process tax returns, collect tax payments, and issue refunds to those who have overpaid. They also provide a lot of information and resources on their website, irs.gov, to help taxpayers understand their obligations. This brings us to the next critical question. Who actually has to pay taxes and file a tax return? The simple answer is, almost everyone who earns an income, but the reality has a few more details. The U.S. operates on what's called a pay-as-you-go system. This means you are expected to pay taxes on your income as you earn it throughout the year, not just in one big lump sum on tax day. If you're an employee, you've seen this in action on your paycheck. Your employer withholds an estimated amount for taxes from each paycheck and sends it to the IRS on your behalf. If you are self-employed or have other sources of income, you might be required to make estimated tax payments quarterly throughout the year. Whether you are legally required to file a tax return depends on a few key factors: your gross income, your filing status, and your age. Let's break that down. Gross income is all the money you receive during the year that is not exempt from tax. This includes your salary from a job, income from freelancing or a side business, tips, and even unearned income like interest from a savings account or certain investment gains. Your filing status is based on your marital and family situation. The 5 main filing statuses are single, married filing jointly, married filing separately, head of household, and qualifying widow, or. Your filing status is important because it determines your standard deduction amount and the tax brackets you fall into, which we will cover in a later chapter. The IRS sets a minimum gross income threshold for each filing status and age group. If your income for the year is above that threshold, you are generally required to file a federal income tax return. It's very important to know that these income thresholds change from year to year, due to inflation adjustments and changes in tax law. Therefore, you must always check the official IRS guidelines for the specific tax year you are filing for. You can find this information on the IRS website in a document called Publication 501. Even if your income is below the filing threshold, there are still situations where you might want to file a tax return. For example, if your employer withheld federal income tax from your pay, the only way to get a refund for any amount you overpaid is to file a return. Also, you might be eligible for certain tax credits, like the Earned Income Tax Credit, which could result in you receiving money back from the government. If you don't file, you can't claim those credits. To summarize this first chapter, taxes are our collective payments to the government for essential public services like schools, roads, and national security. The IRS is the federal agency that collects these taxes. Whether you are required to file a tax return depends on your gross income, filing status, and age, and you should always check the official IRS rules for the current year. Understanding these fundamentals is the first and most important step in navigating the U.S. tax system without stress. In our next chapter, we will start to build your tax vocabulary by defining some of the most common and important terms you'll encounter on your journey. Welcome back to a simple guide to the U.S. tax system for beginners. In our last chapter, we covered the fundamental questions of what taxes are, why we pay them, and who is generally required to file a tax return. Today, in Chapter 2, we're going to build your tax vocabulary. The world of taxes is filled with specific terms and acronyms that can sound confusing, but once you understand them, the whole process becomes much clearer. Think of this chapter as your personal tax dictionary. As always, a quick and important reminder: this guide is for educational and informational purposes only. It is not a substitute for professional tax, legal, or financial advice. The tax code is complex and your personal situation is unique, so please consult a qualified professional for guidance. Let's begin decoding some essential tax lingo. First up is gross income. This is a term we briefly mentioned in Chapter 1. Your gross income is, for the most part, all the income you receive from all sources before any taxes or deductions are taken out. This includes your salary or wages from a job, tips, income from freelancing or a side business, unemployment benefits, and even unearned income like interest from a savings account or dividends from stocks. It's the starting point for calculating your taxes. From gross income, we get to our next term, adjusted gross income, or AGI. This is a very important number on your tax return. Your AGI is your gross income minus certain specific, above-the-line deductions. These are deductions you can take even if you don't itemize. Common examples include deductions for student loan interest, contributions to a traditional individual retirement account, or IRA, and certain self-employment expenses. Your AGI is used to determine your eligibility for various tax credits and other deductions, so it's a key figure in the tax calculation process. This leads us right into the concept of deductions. A tax deduction is an amount of money that you can subtract from your adjusted gross income to lower the amount of income that is actually subject to tax. There are two types of deductions you'll hear about: the standard deduction and itemized deductions. You can only choose one. The standard deduction is a specific dollar amount, fixed by law, that you can deduct. This amount depends on your filing status, your age, and whether you are blind. The standard deduction is designed to simplify the tax filing process. The majority of taxpayers use the standard deduction because it's easy and often results in a lower tax bill than itemizing. Itemized deductions, on the other hand, require more work. This is where you list out all of your specific eligible expenses for the year. Some common itemized deductions include mortgage interest on a home, state and local taxes, up to a certain limit, large medical and dental expenses, and charitable contributions. You would only choose to itemize if the total of all your eligible itemized deductions is greater than the standard deduction for your filing status. After you subtract your chosen deduction, either standard or itemized, from your adjusted gross income, you arrive at your taxable income. This is the amount of your income that is actually used to calculate how much tax you owe. So the formula is, adjusted gross income minus deductions equals your taxable income. Now let's talk about one of the most important concepts to understand: the difference between a tax deduction and a tax credit. Many people use these terms interchangeably, but they are very different and have a different impact on your finances. As we just discussed, a tax deduction reduces your taxable income. A tax credit, however, is even better. A tax credit is a dollar-for-dollar reduction of your actual tax bill. Let's use a simple analogy. Imagine a deduction is like a coupon that gives you a discount on the price of an item before the sales tax is calculated. A credit, on the other hand, is like a gift card that you hand to the cashier to directly pay for part of your final bill. For example, a $1,000 tax deduction might only save you $100 or $200 in actual taxes, depending on your tax bracket. But a $1,000 tax credit will save you the full $1,000. That's why tax credits are generally more valuable than tax deductions. There are many different credits, such as the child tax credit, credits for education expenses, and credits for energy-efficient home improvements. Next, let's define a dependent. A dependent is a person, typically a child or a qualifying relative, who relies on you for financial support. Claiming a dependent can make you eligible for certain filing statuses, deductions, and valuable tax credits, which can significantly lower your tax bill. There are very specific rules about who can be claimed as a dependent, based on their age, relationship to you, and how much support you provide. Finally, let's touch on two of the most common tax forms you will see: the W-2 and the 1099. If you are an employee, your employer will send you a Form W-2 at the beginning of each year. This form shows your total wages for the previous year, and very importantly, how much money was already withheld from your paychecks for federal, state, and other taxes. If you are an independent contractor, a freelancer, or self-employed, you will likely receive a Form 1099 NEC. This form reports how much a client or company paid you for your services. Unlike a W-2, a 1099 form typically does not show any taxes withheld, because as a contractor, you are responsible for paying your own income and self-employment taxes. Understanding these key terms, from AGI and deductions to credits and tax forms, is the foundation for tackling your taxes with confidence. In our next chapter, we'll move from theory to practice. We will discuss all the common documents and pieces of information you'll need to gather before you even think about starting your tax return. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. In the first two chapters, we discussed the why behind taxes and defined the key terms you need to know. Now it's time to get practical. In this chapter, we're going to talk about organization and preparation. Proper preparation can transform tax time from a stressful scramble into a manageable task. This chapter, titled Getting Organized, the documents you need to file your taxes, will walk you through the common types of paperwork you should gather before you start the filing process. And as always, our standard reminder: this content is for educational purposes only. It is not intended as financial, legal, or tax advice. The documents you need will vary based on your personal circumstances. For specific advice, it is always best to consult with a qualified tax professional. Think of filing your taxes like cooking a meal. Before you can start cooking, you need to gather all your ingredients. In the tax world, your documents are your ingredients. Trying to file without them will lead to frustration and potential mistakes. Let's break down the documents you'll likely need into a few key categories. First is personal information. This is the most basic but essential information. You will need the full names, exact dates of birth, and social security numbers, or individual taxpayer identification numbers, for yourself, your spouse, and anyone you are claiming as a dependent. Double-checking this information is critical, as a simple typo in a social security number is one of the most common reasons a tax return is rejected by the IRS. You will also need your current mailing address. If you want your refund sent via direct deposit, you'll need your bank account number and the bank's routing number. The second and largest category is income documents. These forms provide proof of all the money you earn throughout the year. The most common is the Form W-2, wage and tax statement, which you should receive from each of your employers by the end of January. If you did freelance work, or an independent contractor, or received other non-employee compensation, you'll look for Form 1099 NEC. Companies that paid you $600 or more for your services are required to send you one. There are many other types of 1099 forms that report other income. For instance, Form 1099 INT shows interest you earned from a bank account. Form 1099 DIV reports dividends from investments. If you received unemployment benefits, that income will be reported on Form 1099G. If you took money out of a retirement account, you'll receive a Form 1099-R. The key is to gather every income statement you receive, as all this income generally needs to be reported. The third category is records of potential deductions and credits. This is where good record keeping throughout the year really pays off. Remember from Chapter 2, deductions and credits can lower your tax bill, but you need proof to claim them. If you're a student or paying for a dependent's education, you'll want to find Form 1098-T, tuition statement, which shows how much you paid in tuition. You might also have a Form 1098-E for student loan interest you paid. For homeowners, Form 1098, Mortgage Interest Statement, is key if you plan to itemize deductions. You should also gather records of any property taxes you paid. If you made significant charitable donations, you'll need the receipts or acknowledgement letters from the organizations. For large non-cash donations, such as a car, there are special forms and rules. Another area is medical expenses. If you had very high out-of-pocket medical or dental costs during the year, gather those receipts and statements. While the threshold to deduct these is quite high, it's good to have them just in case. If you are self-employed, your record keeping is even more crucial. You'll need a summary of your business-related expenses, which could include office supplies, mileage logs for business travel, software costs, and utility bills if you have a home office. The final category is last year's tax return. While not strictly required, having a copy of your previous year's federal and state tax returns is incredibly helpful. It serves as a great reference and starting point. For instance, some tax software requires your prior year adjusted gross income, AGI, to verify your identity when you file electronically. It also reminds you of certain income sources or deductions you might have forgotten about. To recap, the main document categories are personal information for everyone on the return, income documents, like W-2s and all types of 1099s, records for deductions and credits, such as tuition payments, mortgage interest and charitable donation receipts, and a copy of last year's tax return. Creating a specific folder, either physical or digital, and placing these documents inside as you receive them will make the entire process smoother when it's time to file. Now that you know what ingredients to gather, you're one step closer to preparing your tax return. In our next chapter, we'll discuss the different methods you can use to actually file your taxes. Thank you for listening. Welcome back to a simple guide to a U.S. tax system for beginners. So far, we've covered the basics of why we pay taxes, learned key tax terminology, and created a checklist of the documents you need to gather. Now you have all your ingredients ready. The next logical question is, how do you actually cook the meal? In this chapter, Ways to File, exploring your options from DIY software to hiring a pro, we'll explore the primary methods for preparing and submitting your tax return to the IRS. Before we begin, you know the drill. This guide is for informational and educational purposes only, and does not constitute professional tax or financial advice. The best filing method for you depends entirely on your personal financial situation, your comfort level with numbers, and the complexity of your return. Always consider your own circumstances when making a decision. Broadly speaking, there are 3 paths you can take to file your taxes: doing it yourself manually, using tax software, or hiring a professional. Let's look at each one. The first method is the traditional, old-school approach, manual filing with paper forms. The IRS provides all the necessary forms and instructions, which you can download from their website, irs.gov, or sometimes find at a local library or post office. You would then fill everything out by hand, do all the calculations with a calculator, attach copies of your W-2s and other necessary documents, and mail the completed return to the IRS. The main advantage here is that it's free, aside from the cost of postage. However, this method requires the most effort and has the highest chance of human error. A simple math mistake could lead to an incorrect return, potentially delaying your refund or causing other issues. Because of the rise of more user-friendly options, very few people choose to file this way anymore, but it is still an available option. The second, and by far the most popular method today, is using do-it-yourself DIY tax software. There are many well-known software products available, which you can either purchase and download to your computer or use online. These programs are designed to be user-friendly, guiding you through the filing process with a question-and-answer format. You input the information from your tax documents, and the software does all the calculations for you. It helps identify potential deductions and credits you might be eligible for, and checks for errors before you file. Most of these programs allow you to file electronically, or e-file, which is the method the IRS recommends. E-filing is faster and more secure than mailing a paper return, and you typically receive your refund much quicker, especially if you use direct deposit. Within the world of tax software, there's a fantastic option for many people called IRS Free File. The IRS partners with several tax software companies to offer free online tax preparation and e-filing to taxpayers whose adjusted gross income is below a certain threshold. This threshold changes each year, so you'll need to check the IRS website for the current income limit. If you qualify, you can use one of these trusted programs at no cost. The third method is hiring a tax professional. This is for individuals who have a complex financial situation, or simply want the peace of mind that comes with having an expert handle their taxes. A complex situation could involve being self-employed with lots of business expenses, owning rental properties, having significant investment activity, or experiencing a major life event like a marriage, divorce, or inheritance. There are several types of tax professionals. A certified public accountant, or CPA, is a state-licensed accountant who can handle complex financial situations. An enrolled agent, or EA, is a tax specialist who is licensed by the IRS itself. There are also many non-credentialed but experienced tax preparers. If you choose to hire someone, it's very important to check their qualifications and history. The IRS has an online directory of preparers with recognized credentials. The primary benefit of hiring a professional is expertise. They are up to date on the latest tax laws and can help you navigate tricky situations and potentially find deductions or credits you might have missed. The main drawback, of course, is the cost, which can range from a modest fee for a simple return to a much higher amount for complex work. So to recap the three main paths: manual paper filing, the original DIY method, free but requires careful work and has a higher risk of error; DIY tax software, the most popular option, user-friendly, and often low-cost or even free, with the benefits of e-filing; hiring a tax professional, ideal for those with complex finances or who want expert guidance and are willing to pay for the service. There is no single best way to file. The right choice is the one that fits your life. Now that you know your filing options, you need to know when to file. In our next chapter, we'll cover the tax calendar, key deadlines, and what happens if you need more time. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. In our last chapter, we explored the different ways you can file your tax return. Now that you know your options for how to file, it's equally important to understand when you need to file. Timing is a critical component of the tax process. In this chapter, the tax calendar, important deadlines and what happens if you miss them, will outline the key dates you need to know and explain the concepts of extensions and penalties. As we always mention, this guide is for informational and educational purposes only. Deadlines can sometimes change due to holidays or government announcements. This information should not be taken as legal or tax advice. Always verify current deadlines on the official IRS website or with a tax professional. The most famous date on the U.S. tax calendar is April 15th. For most people, this is the deadline to file their federal individual income tax return. It's also the deadline to pay any taxes you still owe for the previous year. If April 15th falls on a weekend or a holiday, the deadline is typically pushed to the next business day. This day is often referred to as tax day. However, the tax year doesn't begin in April. It really starts on January 1st. From early January through the end of the month, you should be on the lookout for important tax documents to arrive in the mail or become available online. As we discussed in Chapter 3, this includes your W-2 forms from employers and various 1099 forms for other income. By law, employers and businesses are required to send these forms out by January 31st. The IRS officially starts accepting tax returns in late January or early February. Once you have all your necessary documents, you can file at any point before the April deadline. Many people choose to file early, especially if they are expecting a refund. The sooner you file, the sooner you can get your money back. Now, what happens if you realize you can't get your taxes done by the April 15th deadline? Life gets busy, and sometimes you might need more time to get your paperwork in order. For this situation, there is something called an extension. You can request an automatic 6-month extension to file your return. This is done by submitting a specific form to the IRS, called Form 4868, by the April tax day. This will push your filing deadline to October 15th. It's important to note that most tax software programs can help you file an extension electronically in just a few minutes. Here is the most critical point to understand about extensions. An extension to file is not an extension to pay. If you owe the government money, you are still required to estimate the amount you owe and pay it by the original April 15th deadline. If you file an extension but don't pay what you owe on time, you could face penalties and interest on the unpaid amount. An extension simply gives you more time to complete the paperwork, not more time to pay the bill. This brings us to the topic of penalties and interest. The IRS can charge penalties for several reasons, but the two most common are the failure to file penalty and the failure to pay penalty. The failure to file penalty is for not filing your return by the deadline, including any extensions. The failure to pay penalty is for not paying the taxes you owe by the original due date. Generally, the failure to file penalty is significantly higher than the failure to pay penalty. This means that even if you know you can't afford to pay your full tax bill by April 15th, you should still file your return on time or file an extension. Filing something is always better than filing nothing. If you don't file and don't pay, the IRS will also charge interest on the unpaid amount. This interest can add up quickly. If you find yourself in a situation where you owe taxes, but can't afford to pay the full amount at once, it's important not to panic and ignore the situation. The IRS has options available, such as payment plans or other arrangements, that can help you manage your tax debt. The key is to be proactive and communicate with the IRS or a qualified tax professional to understand your options. To recap the tax calendar: January. Expect to receive your tax documents like W-2s and 1099s. April 15th. The main deadline to file your tax return and pay any tax you owe. October 15th. The deadline to file if you requested an extension. Always remember that filing an extension gives you more time to complete the forms, but not more time to pay your tax bill. In our next chapter, we will finally get into the numbers and explain how your tax liability is actually calculated by looking at the U.S. system of tax brackets and rates. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. We've covered a lot of ground so far, from why we pay taxes to the documents you need and the deadlines you have to meet. Now we're going to tackle the core calculation and answer the big question: how is the amount of tax you owe actually determined? In this chapter, how your tax is calculated, understanding tax brackets and rates, we will demystify the U.S. progressive tax system. And as a crucial part of every chapter, please remember this information is for educational purposes only. The tax rates and brackets discussed here are for illustrative purposes. They change almost every year due to inflation and new legislation. This is not tax advice, and you should always refer to the official IRS publications for the current year's figures, or consult a tax professional. The United States uses a progressive tax system. This means that people with higher taxable incomes are subject to higher tax rates. However, this is also one of the most misunderstood concepts in personal finance. A common myth is that if you earn more money and get bumped into a higher tax bracket, all of your income will be taxed at that new, higher rate. This is completely false. The best way to think about tax brackets is like a series of buckets. Each bucket can only hold a certain amount of your income, and each bucket has a different tax rate assigned to it. You fill up the buckets in order, from the lowest rate to the highest. Let's walk through a simplified, fictional example. Imagine for a single person, there are just 3 tax brackets. The first bucket has a 10% tax rate and holds up to $10,000. The second bucket has a 12% tax rate and holds the next portion of income, from $10,001 up to $40,000. And the third bucket has a 22% rate for any income over $40,000. Now, let's say your taxable income for the year is $50,000. You don't just pay 22% on the entire $50,000. Here's how it actually works. First, you fill the 10% bucket. The first $10,000 of your income is taxed at 10%. That's $1,000 in tax. Next, you move to the 12% bucket. This bucket holds the income between $10,001 and $40,000. The amount of your income that falls into this bucket is $30,000. So you pay 12% on that $30,000, which is $3,600 in tax. Finally, we look at the third bucket, the 22% bracket. Your total taxable income was $50,000. You've already accounted for the first $40,000. That leaves $10,000 of your income to fall into this highest bucket. So you pay 22% on that final $10,000, which is $2,200 in tax. To find your total tax, you just add up the tax from each bucket. $1,000 plus $3,600 plus $2,200 equals a total tax of $6,800. This leads us to 2 important terms: your marginal tax rate and your effective tax rate. Your marginal tax rate is the rate you pay on your last dollar of earnings. In our example, your marginal tax rate is 22%, because that's the rate of the highest bracket your income falls into. This is the rate people are usually referring to when they say, "I'm in the 22% tax bracket." It's the rate that would apply to any additional money you might earn. However, your effective tax rate is your actual tax rate. It's the total tax you paid divided by your total taxable income. In our example, you paid $6,800 in tax on $50,000 of income. If you do the math, your effective tax rate is 13.6%. As you can see, This is much lower than your marginal rate of 22%. Your effective tax rate gives you a much more accurate picture of what percentage of your income you actually paid in taxes.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
It's important to remember that the income ranges for these brackets depend on your filing status. The brackets for someone who is married filing jointly are much wider than for someone who is single, meaning they can earn more income before moving into the next higher bracket. So, to summarize this key concept, the US has a progressive marginal tax system. You don't pay your top tax rate on all of your income. Instead, your income is taxed in portions, at successively higher rates as you move up through the brackets. Understanding this can help you see that earning more money will always mean you take home more money, even if it pushes you into a higher tax bracket. In our next chapter, we'll broaden our scope and discuss the fact that federal income tax isn't the only tax most people pay. We'll take a look at other common taxes, such as FICA taxes for Social Security and Medicare, as well as state and local taxes. Thank you for listening. Welcome back to a simple guide to the US tax system for beginners. In our last chapter, we untangled the complex world of tax brackets and learned how your federal income tax is calculated. While federal income tax gets most of the attention, it's definitely not the only tax you'll encounter. In this chapter, not just income tax, a brief look at other common taxes, we will introduce you to the other taxes that are a regular part of most Americans' financial lives. As we continue, please keep in mind that this information is for educational purposes only. Tax laws, especially at the state and local level, vary significantly. This is a general overview and is not a substitute for specific advice from a qualified professional. Let's start with a tax you've likely seen on your paycheck: FICA tax. FICA stands for the Federal Insurance Contributions Act. This is a federal payroll tax, and the money collected is used to fund two of the largest social programs in the United States: Social Security and Medicare. Unlike the progressive federal income tax we discussed in the last chapter, FICA taxes are calculated at a flat rate. The tax is actually split into two parts. The first part is for Social Security, which provides retirement, disability, and survivor benefits. There is a specific tax rate for Social Security that you pay on your earnings up to a certain annual income limit. Any income you earn above that limit is not subject to the Social Security tax for the year. The second part is for Medicare, which provides health insurance for people aged 65 and over, and for some younger people with disabilities. The Medicare tax also has its own rate, but unlike Social Security, there is no income limit. You pay the Medicare tax on all of your earned income. One of the key features of the FICA tax is that you don't pay it alone. Your employer is required to match your contribution. They pay the exact same amount that is withheld from your paycheck. So the total amount sent to the government is double what you see deducted from your pay. If you are self-employed, you are responsible for paying both the employee and employer portions, which is collectively known as the self-employment tax. Next up are state and local taxes. While the federal government collects taxes to run the country, your state and local governments also need revenue to operate. This is where things can get very different depending on where you live. Most states, but not all, have a state income tax. The way these taxes are calculated varies widely. Some states have a progressive bracket system similar to the federal one. Other states have a flat tax, where everyone pays the same percentage regardless of their income level. And a handful of states have no state income tax at all. In addition to state income tax, many people pay property taxes. This is a tax on the value of real estate you own, such as your house and land. Property taxes are typically collected by local governments, like your county or city, and are the primary source of funding for public schools, local police and fire departments, and other community services. Another common tax is the sales tax. This is a tax you pay on goods and services you purchase. You see this added to your bill when you buy something at a store or a restaurant. The sales tax rate varies dramatically from state to state, and even from city to city, as both state and local governments can impose them. Some states have no statewide sales tax. Depending on where you live and work, you might also encounter other local taxes, such as a city wage tax or school district taxes. The key takeaway is that your total tax picture includes much more than just the federal income tax you file every April. To recap, FICA taxes are flat-rate federal payroll taxes that fund Social Security and Medicare, and are matched by your employer. State and local taxes vary greatly by location, and can include state income taxes, property taxes on real estate, and sales taxes on goods and services. Understanding these different layers of taxation gives you a more complete view of how our government systems are funded at every level. In our next chapter, we will bring these concepts into the real world by looking at how common life events, like getting a new job, getting married, or having a child, can impact your tax situation. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. We've built a strong foundation by learning about tax vocabulary, filing procedures, and how taxes are calculated. Now let's connect that knowledge to the real world. Life is constantly changing, and major life events often bring changes to your tax situation. In this chapter, Common Life Events in Your Taxes, we will explore how milestones like starting a job, getting married, having a baby, or buying a home can affect your taxes. As this chapter touches on very personal situations, our disclaimer is more important than ever. This is a general educational overview and is not tax or financial advice. How these events affect you depends on your unique circumstances. It is always recommended to review your situation with a qualified professional after a major life event. Let's start with an event most of us experience: starting a new job. When you're hired as an employee, one of the first pieces of paperwork you'll fill out is Form W-4, the Employee's Withholding Certificate. This form is not your tax return, it's an instruction sheet for your employer. It tells them how much federal income tax to withhold from each of your paychecks. The W-4 asks for information about your filing status, the number of dependents you have, and if you have other income from a second job or a working spouse. The goal is to have the amount withheld be as close as possible to the amount you'll actually owe at the end of the year. If you withhold too little, you'll have a big tax bill on tax day. If you withhold too much, you're essentially giving the government an interest-free loan, and you'll get it back as a refund. You can change your W-4 with your employer at any time, not just when you start a new job. It's a good idea to review it whenever you experience a major life change. Next, let's talk about getting married. When you get married, your tax life changes significantly because your filing status changes. For the entire year in which you are married, even if you get married on December 31st, you are considered married by the IRS. You can no longer file as single. Your new options are typically married filing jointly or married filing separately. Most couples choose to file jointly. This allows them to combine their incomes and deductions onto one tax return. This status often provides a larger standard deduction and makes you eligible for certain tax credits that aren't available if you file separately. In many cases, particularly when one spouse earns significantly more than the other, filing jointly can result in a lower overall tax bill because of how the tax brackets are structured for joint filers. Another major life event is having or adopting a child. This is a huge change for your family and your taxes. When you have a child, you can typically claim them as a dependent. As we learned in an earlier chapter, claiming a dependent can be very valuable. It may make you eligible for a more favorable filing status, like head of household if you are single. Most significantly, having a qualifying child makes you eligible for important tax credits, most notably the child tax credit. Remember, a credit is a dollar-for-dollar reduction of your tax bill, so this can have a major impact. There are other credits as well, such as the Child and Dependent Care Credit, if you pay for childcare so you can work. Finally, let's touch upon buying a home. For many, this is the largest purchase they will ever make. Homeownership can open the door to significant tax deductions, but only if you choose to itemize your deductions instead of taking the standard deduction. Two of the most common deductions for homeowners are for mortgage interest and property taxes. The bank that holds your mortgage will send you a form each year showing how much interest you paid. You can also deduct the state and local property taxes you pay on your home, though there is a combined limit on how much state and local tax you can deduct. For these deductions to be beneficial, their total, along with any other itemized deductions like charitable giving, must be greater than your standard deduction. In summary, life events are tax events. Starting a job introduces the W-4 and withholding. Getting married changes your filing status. A new child can provide valuable tax credits. And buying a home may unlock new tax deductions. In our next chapter, we will shift our focus to a situation that is becoming more and more common: earning income outside of a traditional job. We'll cover the basics of taxes for freelancers, gig workers, and small business owners. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. In our last chapter, we looked at how major life events impact the taxes of a typical employee. But today, more and more people are earning income differently, through freelancing, gig work, or running their own small business. This path comes with a different set of tax rules. In this chapter, the basics of self-employment and taxes, we will cover the fundamental concepts you need to be aware of when you are your own boss. It is especially important to state that the world of business tax is complex. This chapter is a very basic overview for educational purposes only, and is not a substitute for professional tax advice. If you are self-employed, working with a qualified tax professional is often a very good idea. So, what does it mean to be self-employed in the eyes of the IRS? Generally, you are self-employed if you carry on a trade or business as a sole proprietor or an independent contractor. If you receive a 1099 NEC form instead of a W-2, that's a good sign you're being treated as self-employed. The first big difference is how you handle your taxes. As an employee, your employer withholds taxes for you. When you're self-employed, you are responsible for everything. There are 4 key concepts to understand: the self-employment tax, business deductions, quarterly estimated taxes, and how you report your income. Let's start with the self-employment tax. Remember FICA taxes from Chapter 7, which cover Social Security and Medicare. As an employee, you pay half, and your employer pays the other half. When you're self-employed, you are considered both the employee and the employer. Therefore, you are responsible for paying both portions. This combined tax is known as the self-employment tax. It is a separate tax in addition to your regular income tax. The second concept is business deductions. One of the benefits of being self-employed is that you can deduct the costs of running your business from your business income. This lowers your profit, which in turn lowers both your income tax and your self-employment tax. The IRS rule is that a business expense must be both ordinary and necessary for your trade or business. What counts as an ordinary and necessary expense depends on your industry. However, some common examples may include things like the cost of supplies, software subscriptions used for your business, a portion of your cell phone and internet bills, business-related travel, and marketing or advertising costs. Meticulous record-keeping is absolutely essential here. You need to keep receipts and records for every expense you plan to deduct. After you subtract your business expenses from your business income, you are left with your net profit. This is the amount that is subject to tax. Third, we have quarterly estimated taxes. Because no one is withholding taxes from your paychecks, you can't wait until April 15th to pay all your taxes for the year. The US has a pay-as-you-go system, and this applies to the self-employed too. You are generally required to pay your income tax and self-employment tax throughout the year in 4 quarterly installments. These are called estimated tax payments. You have to estimate how much you'll earn and how much you'll owe for the entire year, and then pay that amount in 4 chunks. The due dates for these payments are typically April 15th, June 15th, September 15th, and January 15th of the next year. If you don't pay enough tax throughout the year via these estimated payments, you could face an underpayment penalty from the IRS. Finally, how do you report all of this? Your self-employment income and expenses are typically reported on a form called Schedule C, Profit or Loss from Business, which you file along with your main Form 1040 tax return. The net profit from your Schedule C then flows to your main return to be included in your income. Your self-employment tax is calculated on a separate form, Schedule SE. To recap, being self-employed means you are in charge of your own taxes. You'll need to account for self-employment tax, keep detailed records of your business deductions to lower your taxable profit, and likely make estimated tax payments 4 times a year. In our next chapter, we will discuss a topic that's important for everyone, whether you're an employee or self-employed: saving for the future. We'll explore the tax advantages of common retirement accounts. Thank you for listening. Welcome back to a simple guide to the US tax system for beginners. So far, we've talked a lot about paying taxes on the money you earn. But what if there was a way to get a tax break for saving money for your future? There is, and it's one of the most powerful tools available for personal finance. In this chapter, we'll discuss the tax advantages of the most common retirement savings accounts, like 401(k)s and IRAs. Let's start with our very important disclaimer. This chapter discusses the tax treatment of retirement accounts, not their investment aspects. This is not financial or investment advice. The decision of how and where to save for retirement is a major one that should be made based on your personal goals, and often with the help of a qualified financial advisor. Why the government gives you a tax break? The government wants to encourage people to save for their own retirement. To do this, they've created special, tax-advantaged accounts. This is just a fancy way of saying these accounts have special tax rules that can help your money grow more effectively than it would in a regular savings or brokerage account. The two most common types of retirement accounts are 401(k)s and IRAs. A 401(k) is typically an employer-sponsored plan that you contribute to directly from your paycheck. An IRA, or individual retirement arrangement, is an account that you can usually open and fund on your own. Within these categories, the accounts are generally split into two main tax flavors: traditional and Roth. Understanding the difference is all about answering one simple question. Do you want to pay the taxes now or pay them later? Traditional accounts, the pay taxes later approach. Traditional 401(k)s and traditional IRAs operate on a tax-deferred basis. Here's how it works. You get a tax break today. The money you contribute to a traditional account is often pre-tax. This means your contributions can be deducted from your income for the year, which lowers your immediate tax bill. For example, if you earn $50,000 and contribute $5,000 to your traditional 401(k), you will generally only be taxed on $45,000 of income for that year. Your money grows tax-deferred. Inside the account, your investments can grow and earn dividends or interest year after year without you having to pay any taxes on those gains along the way. You pay taxes on withdrawals in retirement. When you retire and start taking money out of the account, those withdrawals are treated as regular income and are taxed at whatever your tax rate is at that time. Think of it like this. The government lets you put money into the account before taxes are taken out, lets it grow in a tax-sheltered way, and then you pay the taxes at the end when you withdraw it. Roth accounts, the pay taxes now approach. Roth 401(k)s and Roth IRAs are the mirror image of traditional accounts. You do not get a tax break today. You contribute money that has already been taxed. Because of this, your contributions are not tax-deductible and don't lower your current taxable income. Your money grows tax-free. Just like a traditional account, your investments can grow inside the account without being taxed each year. Your qualified withdrawals in retirement are tax-free. This is the main benefit. When you reach retirement age and start taking money out, you owe zero federal income tax on those withdrawals, including all the investment earnings. With a Roth, you are essentially choosing to pay the taxes now on the seed money, so that you don't have to pay any taxes later on the entire harvest. The choice between traditional and Roth depends on many factors, including whether you think your tax rate will be higher or lower in the future. Again, this is a topic to discuss with a financial professional. The key takeaway for our purposes is that the government offers these powerful tools to help you save for the future by giving you a significant tax advantage. In our next chapter, we'll discuss what happens after you've clicked submit on your tax return. We'll cover how to check on your refund, understand a tax bill, and what to do if you get a notice from the IRS. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. You've done the hard work, gathered your documents, filled out the forms, and submitted your tax return. So what happens now? The time after you file can involve a refund, a payment, or sometimes a letter from the IRS. In this chapter, we will walk through these post-filing experiences so you know what to expect. As always, this guide provides general information for educational purposes only. It is not legal or financial advice. For specific questions about your return, refund, or any IRS correspondence, you should refer to the official IRS website or consult with a tax professional. Scenario 1. You are expecting a refund. This is the outcome many people hope for. A refund simply means that you had more tax withheld from your paychecks throughout the year than you actually owed. The government is now returning that overpayment to you. The fastest and easiest way to check the status of your federal tax refund is by using the official Where's My Refund tool on the IRS website, irs.gov, or through their mobile app, IRS2Go. To use it, you'll need 3 pieces of information from your tax return: your Social Security number, your filing status, and the exact refund amount. The tool will show you the status of your refund in 3 stages: return received, refund approved, and refund sent. The IRS updates the tool once every 24 hours, usually overnight, so there's no need to check it more than once a day. Typically, most people who e-file their return and choose to receive their refund via direct deposit will get their money within 21 days. If you mailed a paper return, the process is much slower and can take 4 weeks or more. Scenario 2. You owe more taxes. If your calculations show that you owe the IRS money, it means not enough tax was withheld or paid during the year. Your payment is due by the April 15th deadline to avoid penalties and interest. The IRS offers several safe and easy ways to pay. The most common method is IRS Direct Pay, a free and secure service on their website that lets you pay directly from a checking or savings account. You can also pay with a debit card, credit card, or digital wallet, though third-party processing fees may apply. If you prefer, you can still mail a check or money order. If you cannot pay the full amount you owe by the deadline, the most important thing to do is not to ignore it. The IRS has payment options available. You may be able to set up a short-term payment plan or a long-term installment agreement to pay off your balance over time. You can apply for these plans directly on the IRS website. Taking proactive steps is always better than letting penalties and interest accumulate. Scenario 3. You receive a notice from the IRS. Receiving an official-looking letter from the IRS in the mail can be intimidating, but it's important not to panic. The vast majority of these notices are not about an audit. They are usually sent for much more common reasons. You might receive a notice because the IRS made a minor correction to your return. They need to verify your identity. They have a question about something you reported, or they are simply notifying you of a change to your refund amount. Here is a general process for how to handle an IRS notice. Read it carefully. The notice will explain exactly why they are contacting you and what, if anything, you need to do. Compare it to your return. If the notice says a change was made, pull out your copy of your tax return and see if you can understand the correction. It could be a simple math error. Respond if necessary. The notice will tell you if a response is required and will give you a deadline. If you agree with the notice, you often don't need to do anything unless a payment is due. If you disagree, the notice will provide instructions on how to dispute the changes. Keep a copy. Always keep a copy of any correspondence you receive from the IRS with your tax records. If you ever receive a notice that is complex or that you don't understand, it is highly recommended that you seek help from a qualified tax professional. In our next chapter, we'll start looking forward. We'll discuss how to use what you've learned this year to make next year's tax season even smoother through some basic tax planning. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. We have now journeyed through an entire tax year, from understanding the basics to filing your return and handling what comes next. The biggest lesson is that tax season is much easier when you're prepared. In this chapter, we'll shift our mindset from being reactive to proactive. We'll discuss tax planning, which isn't about finding secret loopholes. It's simply about making smart, informed financial decisions throughout the year to manage your tax situation effectively. As we discuss these concepts, it is critical to remember that this is for educational purposes only, and is not tax or financial advice. True tax planning is highly personal, and should be done in consultation with a qualified professional who understands your specific financial picture. Concept 1. The Paycheck Checkup. One of the most powerful tools you have to manage your taxes is the Form W-4 at your job, which we discussed in an earlier chapter. You can and should review it periodically, not just when you start a new job. The IRS encourages people to do a paycheck checkup to make sure the right amount of tax is being withheld. A major life event, like getting married, having a child, or a significant change in income, is a perfect reason to review your withholding. You don't want to discover on tax day that you've been withholding far too little and now owe a large sum, or that you've been withholding far too much and gave the government a large, interest-free loan all year. To help with this, the IRS provides a free tool on its website called the Tax Withholding Estimator. You can input your information anonymously, and it will help you determine if your current withholding is on track. It's an official resource designed to help you get it right. Concept 2. Master your record keeping. We've mentioned record keeping before, but its importance in tax planning cannot be overstated. A stressful tax season often begins with a frantic search for documents. A smooth tax season begins with a simple system set up in January. You don't need complex software. It can be as simple as a dedicated digital folder on your computer, or a physical accordion file. Create labels for common categories: income statements, charitable donations, medical expenses, business expenses, and so on. When you make a cash donation to a charity, scan the receipt and put it in the digital folder immediately. When you receive an email receipt for a business-related software subscription, save it to the folder. By making it a habit throughout the year, you ensure that when it's time to file, all your potential deductions are organized and accounted for, saving you time and stress. Concept 3. Be aware of timing. For some individuals, especially those who are self-employed or itemize their deductions, the timing of certain financial activities can matter. For example, if you plan to make a large charitable donation, making it in December counts for the current tax year, while making it in January counts for the next tax year. Similarly, A freelancer might have some control over when they purchase business equipment or send an invoice. This is not about manipulating your income, but simply being aware that the calendar year cutoff is a hard line. Understanding this concept can be a part of a larger financial strategy that you would develop with a professional. Concept 4. Stay informed from the source. Tax laws are not static. They can and do change. While you don't need to be an expert, it's helpful to be aware of major changes that might affect you. The most reliable and direct source for this information is the IRS itself. The newsroom on the irs.gov website provides updates on tax law changes, deadline extensions, and other important news for taxpayers. By adopting a proactive mindset with these basic concepts, you transform tax preparation from a once-a-year chore into a simple, ongoing part of your financial management. In our next chapter, we will take a deeper look at a topic that confuses many new workers and freelancers: the key differences between being an employee and an independent contractor. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. We've mentioned the terms employee and independent contractor several times throughout this series. In today's economy, with the rise of freelance and gig work, understanding the difference is more important than ever. In this chapter, we'll take a deeper dive into these two classifications and what they mean for your taxes. Let me be very clear. This information is for educational purposes only. Worker classification can be a complex legal and tax issue. This is a general overview of the tax differences, not a guide to determine your own status or the status of someone you hire. For that, you should always consult the official IRS guidelines and a qualified professional. The core difference: control. At its heart, the difference between an employee and an independent contractor comes down to the degree of control. The IRS generally looks at who has the right to direct and control how the work is done. An employee is someone whose employer has the right to control not only the end result of the work, but also the details of how the work is done. Think about when you work, where you work, and the tools you use. An independent contractor, on the other hand, is in business for themselves. The person paying them has the right to control only the result of the work, not the methods or details of how it's accomplished. This core difference in control leads to all the tax differences we're about to discuss. Comparing the tax realities. Let's compare the two roles side by side in key tax areas. 1. The tax forms. W-2 employee. At the end of the year, you receive a Form W-2 from your employer. This form shows your total wages and a detailed breakdown of all the taxes that were withheld from your pay. 1099 contractor. You receive a Form 1099 NEC from each client who paid you $600 or more. This form simply shows the total amount you were paid. It does not show any taxes withheld because there weren't any. 2. Tax withholding. W-2 employee. As we've discussed, your employer automatically withholds federal income tax, state income tax, and FICA taxes from every paycheck. This is the essence of the pay-as-you-go system for employees. 1099 contractor. You receive your full, gross payment from your client with zero taxes withheld. You are solely responsible for setting aside money and paying your own taxes throughout the year. This usually means making quarterly estimated tax payments. 3. Social Security and Medicare taxes. W-2 employee. You pay your half of the FICA taxes, 7.65% of your pay, and your employer pays the other matching half. 1099 contractor. You are responsible for the entire amount, both the employee and employer portions. This is the self-employment tax, which is 15.3% of your net earnings from self-employment. 4. Business expenses. W-2 employee. You generally cannot deduct unreimbursed job-related expenses on your federal tax return. For example, if you buy your own office supplies or use your personal car for work errands and aren't reimbursed, that's typically just a personal cost. 1099 contractor. You can and should deduct all of your ordinary and necessary business expenses. This could include your computer, software, mileage, a home office, and more. These deductions lower your net profit, which in turn lowers both your income tax and your self-employment tax. 5. Benefits and protections. W-2 employee. Your status as an employee makes you eligible for benefits like employer-sponsored health insurance, retirement plans like a 401k, paid time off, and protections like unemployment insurance and workers' compensation. 1099 contractor. You are not eligible for any of these employer-provided benefits. You are responsible for your own health insurance, retirement savings.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
And you do not have access to unemployment benefits from your clients if the work ends. In summary, being an employee offers simplicity and stability in taxes and benefits, while being a contractor offers greater flexibility, but requires much more responsibility for managing your own tax and financial obligations. In our next chapter, we'll address a common fear for beginners: what to do if you file your taxes and then realize you made a mistake. Thank you for listening. Welcome back to a simple guide to the U.S. tax system for beginners. After all the work of preparing and filing your taxes, the last thing you want to think about is that you might have made a mistake. But it's important to know that it happens, and there is a clear, established process for fixing it. In this chapter, we'll discuss what to do if you discover an error on a tax return you've already filed. We'll cover the concept of an amended tax return. As always, a reminder that this is informational and educational content only. The process for amending a return can be detailed, and this chapter is a general overview, not specific tax advice. If you need to amend a return, especially for a complex issue, consulting a tax professional is highly recommended. First, don't panic. The most important first step is not to panic. The IRS knows that people make mistakes. Forgetting a form, using the wrong filing status, or missing a deduction are common errors. The IRS has a specific form and process just for these situations. It's also important to know what doesn't require an amendment. You typically do not need to file an amended return to fix a simple math error. The IRS computers will usually catch and correct those for you. Similarly, if you forgot to attach a form like your W-2, the IRS will typically just send you a letter requesting it. You should only amend your return for more significant changes to your filing status, income, deductions, or credits. Introducing Form 1040X, the amended return. To correct a mistake on a previously filed federal income tax return, you use Form 1040X, Amended U.S. Individual Income Tax Return. This is a special form that shows the IRS the before and after of your tax return. Form 1040X has a 3-column format. Column A shows the figures from your original tax return. Column C shows the new corrected figures. Column B shows the difference between the two, which is the net change you are making. On the form, you will also have to provide a written explanation for why you are making the changes. For example, I received another Form 1099 for freelance work after I filed my return. Or, I am now claiming the education credit I was eligible for. The process and timeline. Filing an amended return is not a fast process. First, you should wait until your original return has been fully processed by the IRS before you submit an amendment. If you are expecting a refund from your original return, it's best to wait until you receive it. For many recent tax years, you can now file Form 1040X electronically using tax software, which is the fastest and most recommended method. If you must file on paper, you mail it to the IRS address listed in the form's instructions. There is also a time limit. Generally, to claim a refund from an amended return, you must file the Form 1040X within 3 years from the date you filed your original return, or within 2 years from the date you paid the tax, whichever is later. After you submit it, you can track its status using the Where's My Amended Return tool on the IRS website. Be patient, as it can take the IRS several months to process an amended return. If your amendment results in you owing more tax, you should file and pay as soon as you discover the error to minimize any potential interest and penalties. If the amendment results in a larger refund, the IRS will send it to you after the return is processed. In short, if you make a mistake, don't worry. The IRS provides a clear path to fix it with Form 1040X. In our final chapter, we will bring everything together, review the key takeaways from this series, and discuss where you can find reliable help and information in the future. Thank you for listening. Welcome to the final chapter of a simple guide to the U.S. tax system for beginners. Over the last 14 chapters, we have journeyed from the most basic questions about taxes to understanding deductions, life events, and even how to fix a mistake. Congratulations on investing the time to build a strong foundation of tax knowledge. The goal was never to make you a tax expert, but to empower you with the confidence to navigate the system without fear. In our final chapter, we will recap the most important lessons and, most crucially, point you towards safe and reliable resources you can use in the future. And for one last time, the most important message of this entire series. This guide was created for educational and informational purposes only. It is not, and has never been, a substitute for professional tax, legal, or financial advice. 5 key takeaways to remember. If you remember nothing else from this series, hold on to these 5 core ideas. Taxes are a part of a functioning society. We learned that taxes aren't just a bill. They are our collective contribution to the services we all rely on, from roads and schools to national security. Organization is your best friend. A smooth tax season begins long before April. By keeping good records of your income and potential deductions throughout the year, you turn a stressful task into a manageable one. Your life and your taxes are connected. Major life events like a new job, marriage, a new child, or buying a home will almost certainly impact your taxes. Being aware of this allows you to be proactive. Planning is a year-round activity. Smart tax management isn't a once-a-year event. Simple actions like doing a paycheck checkup with your W-4 can make a huge difference in whether you owe money or get a refund. You are not alone. The tax code is complex, and no one expects you to know everything. There are many legitimate, reliable resources available to help you. Which brings us to our final topic: where to find reliable help. Navigating the tax world can be tricky, but you should never rely on random advice from the internet. Here are 3 official and trustworthy places to turn for help. The official IRS website, irs.gov. This should be your first and most trusted source. The website is home to all the official tax forms, instructions, and publications. It also has free and secure tools you can use, like the Where's My Refund tool, the Tax Withholding Estimator, and the Interactive Tax Assistant, which can answer many common tax law questions. IRS Free Tax Help Programs, VITA and TCE. The IRS sponsors 2 fantastic volunteer programs that provide free basic tax return preparation to qualified individuals. The VITA program, or Volunteer Income Tax Assistance, generally serves people who make below a certain income level, persons with disabilities, and limited English-speaking taxpayers. The TCE program, or Tax Counseling for the Elderly, provides free tax help, particularly for those who are 60 years of age and older. You can search for a local VITA or TCE site on the IRS website. Qualified Tax Professionals. For more complex situations or for personalized advice, a professional is your best option. Look for someone with recognized credentials, like a certified public accountant, CPA, or an enrolled agent, EA. The IRS has an online directory of federal tax return preparers with credentials and qualifications to help you find a qualified professional in your area. Thank you for joining me on this journey. We hope this guide has demystified the U.S. tax system and given you the confidence to manage your tax responsibilities effectively.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.